Hello, this is Chuck Carnevale, and with this video I'm going to take a Fundamentals Analyzer software tool, or F.A.S.T graphs, look at J2 Global Inc. When I was looking and trying to identify attractive investment opportunities, I was really pretty amazed when I came across this company, one that I really hadn't been too familiar with prior to conducting my research. What I have on the screen here is a plotting of the company's adjusted operating earnings results from the beginning of 2003 through last fiscal year ending in 12/31/2016. And what really impressed me was when I discovered this company was how consistent and how fast the earnings have grown. As you can see by just looking at the orange line here, which plots earnings per share at a PE ratio of 22.5, I want you to notice how consistently the company's earnings results have been. It's very rare to find a company with this impeccable of a historical earnings record. At this point, I'm also only looking at history, or through what has already been reported and completed. What also intrigued me, and I'm going to use my scroll feature here and go forward, was the fact that forecasts for the next couple of years are also expected to be very strong, with earnings growth forecast for 2017 at 16% and 15% for 2018. So this is a very impeccable record when looked at from the perspective of earnings. Next, I'm going to bring in dividends by clicking the dividend payout ratio tab here at the bottom. And as you can see, they instituted their first dividend in December of 2011, and the dividend has increased very nicely every year since. If you look at the long-term record of dividend growth, it has been very high, but I do want to point out that they more than doubled their dividend in the first year. But the company now has gone through 22 consecutive quarters of dividend increases. It offers a current yield of 1.8%. It's trading at a blended PE ratio of 16.2 and has a $3.9 billion, almost $4 billion market cap. It's only BB rated by S&P, but also only has 35% debt to capital. So from this perspective, this looks like a very intriguing company. Now next, I'd like to interject or introduce monthly closing stock prices to the graph, and you can see that the price has tracked earnings and correlated to earnings very nicely since the beginning of 2003. Now I'm going to add another valuation reference line, the normal PE ratio, and you see here that it's been very common for the market to value this stock at something close to a 17 PE ratio, which I might add, since the recession of 2008 has been somewhat lower than the company's historical growth rate. But now at this point, I'm going to shorten these time frames, and I want you to focus, I'd like the reader to focus on the earnings growth rate that you see over here in the green adjusted operating earnings box. If I drop this to a shorter time frame here, I want you to notice that earnings growth is still 18.6%. I chop it down to another 10 years, it's still 15%. And again, I want you to notice the correlation between price and operating earnings. And if I drop it down where I'm looking at the last 5 years plus 2 years of forecast, we still see that the company's been growing at about a 15% rate in recent times. And their dividend, as I already pointed out, has been growing very nicely. When you add the dividends after they've been paid out, you can see that the company's payout ratio is still relatively low, and the company's current valuation is within reasonable norms based on adjusted operating earnings. Now, valuation is a puzzle, and there are a lot of pieces to the puzzle in order to paint a good picture of a company. Now, there are a lot of people that like to look at GAAP earnings in lieu of operating earnings. So I'm going to now go into diluted earnings here and draw a picture of this company's historical record of diluted earnings. In this example, this is really important because this company, as I mentioned in the written part of this article, engages in a lot of mergers and acquisitions. They've acquired over 40 companies in recent years, 16 last year alone, and 6 in the final quarter of the year. And I consider this GAAP earnings record actually pretty extraordinary as well, considering the fact that they've engaged in so many activities that would require accounting adjustments and conventions to their earnings. So from a GAAP earnings, the company also looks extremely attractive. And then next, I'm going to show free cash flow, because at the end of the day, free cash flow is a very relevant metric. And I'm going to go ahead and add price to free cash flow and the normal price to free cash flow. This company is historically traded at about a 15 price to free cash flow. And as you can see, it's trading at that level right now, right at 15.1 versus the normal of 15.4. So that simply means it's fairly valued now, which is why I refer to it as attractive. Not necessarily cheap, as it was back in 2012 and so on, and even earlier in the beginning of 2000 or the spring of 2016, but it's still very attractive for a company with this type of free cash flow generation. Remember, free cash flow is after the company spent all the money that is required to run its business. This is what's left over. So the company looks very attractively valued on that basis. And then finally, I'm going to look at EBITDA, or earnings before income taxes, depreciation, and amortization, which is really another form of cash flows in my view, to take a look at how the company has performed on a cash flow, or an EBITDA basis. And again, we see this extremely consistent record. This is something that I really admire and look for in a company that has proven itself. As I mentioned in the article, this tells me a lot about the quality of the company's business, and it also tells me a lot about the capabilities and competency of the management team behind the business. So at this point, I think you might be able to appreciate why I was attracted to this stock. It has a great operating history. Earnings and cash flows have been terrific, and it's currently trading at a reasonable or sound valuation based on all the various metrics that I've looked at. So now I'd like to take a deeper look into some of the fundamentals and turn to the financial underlying numbers, or what we call fund graphs, and look at some of the balance sheet items, profitability, and other important metrics. I'm going to start out by looking at some key balance sheet metrics. I'm going to look at long-term debt per share and total debt per share. And there's a couple of things that are important when you're examining this, and I'm going to shorten the time frame. You can see that the company really had virtually no debt up until 2012. And I also think it's important to recognize that the majority of their debt is long-term debt. So the company has taken on some debt, but at a 35% debt to capital ratio, I still consider the debt manageable, especially in lieu of the cash flows, which I'll talk about here in a second. So next here, I've added free cash flow per share. And as you can see, the company generates a significant amount of free cash flow. And the point being is that this free cash flow signifies to me, or suggests to me at least, that this company is more than capable of handling the debt that it's taken on in lieu of the recent acquisitions they've made. When I'm considering any investment, one of the most important questions I like to ask is, how's business? And in my view, in addition to all of the other metrics we've looked at, there's probably no better metric to try to determine how business is than looking at revenues or sales. And as you can see, JT Global has a very impressive record of revenue growth, and the growth has really become quite astounding in recent years. So this is another fundamental metric that I think is very important. The company generates significant revenue growth over time. And then in addition to that, I'd like to take a look at another balance sheet item, cash and equivalents per share. And as you can see, the company has a lot of cash on hand and has had a lot of cash on hand. And I think this is especially impressive when you consider the fact that they've made all the acquisitions they did in 2016, and they're still left with $2.60 worth of cash on hand per share. Next, I'd like to take a look at some of the company's profitability measurements. And here we've got gross profit margins, the red bars on the graph, and then the blue bar is net profit margins. And that although net profit margins have dropped some in recent years, I think it's also important to recognize the acquisition and merger activity that the company has gone through over the last year or so. But the company is very highly profitable on a gross margin. They produce extraordinary gross margins, and they still maintain, even at these lower levels here, double-digit net margins. So I like that. The final financial underlying number I'm going to look at is the company's common shares outstanding. And here I want you to note that the company has maintained a share count of somewhere between about 45 and 48 million shares, although they did recently announce a commitment to a share buyback. But the company's share count has been very stable over the years. Going back to the earnings and price correlated F.A.S.T graphs, I'd now like to take a look at forecasts. The company is not widely followed. There are 5 analysts forecasting a 19.66%, or excuse me, a 16.43% rate of earnings growth, 7 analysts for 2017, and another 6 analysts forecasting 15.3% for the next year. What's really important about that, when I'm analyzing a business, I always like to note and take notice of how accurate analysts have been with the forecast. And looking at how accurate they've been with a 1-year forward forecast, I want you to notice that analysts have, or or this company has actually exceeded analyst estimates in most years. And the same is also true when the analysts were making a 2-year forward forecast. So when you summarize the record of analyst estimates on this company, it's been really extraordinary. In fact, it can't get any better. Now, that doesn't guarantee that the analysts won't be wrong going forward. And one thing I want to point out, this company has grown through acquisitions and mergers, and that's an unknown. And it's something that I think is important to consider when you're looking at this mid-cap stock. It has tremendous historical growth. It is still forecast to have excellent long-term future growth. But one thing, as I pointed out in the written part of this article, this company will be an entirely different company more than likely 2 or 3 years from now than it is today if you happen to purchase it today. And that's because they'll be adding additional businesses, which is really their long-term business strategy. So you should consider that. All in all, I think this is a very attractive long-term capital gain and growth of dividend income investment. It could produce double-digit returns of 15% or better. If you look at it from a standpoint of free cash flow and free cash flow estimates, those returns could even be higher than that. So this is a company that I think is worth looking at more deeply if your objective is long-term total return. It doesn't have the highest current yield currently, which is something that I'm really looking for personally, but the reality of it is it could be a great total return vehicle. But as always, do your own homework and your own due diligence. But I think this company's worth taking a closer look at.